Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. Today we are going to start Chapter 4. There are two purposes for Chapter 4. The first is to explain the purpose and the process of adjusting entries. The second is to explain the closing process. Now these two topics are pretty complicated if you are new to accounting, especially the adjusting entries. In this video, I'm going to mainly discuss adjusting entries, and in the next video I'll explain closing entries. Let's get started. Let's revisit the accounting cycle. Remember, we start an accounting cycle with analyzing each transaction, recording transactions in journal entries, and post those effects to the general ledger, which is the T account that we are using. We then prepare a trial balance to find out whether we did things correctly. So this would be the first three chapters. Now the trial balance helps us to determine whether we have done our journal entries and ledgers correctly, in the sense that whether the debit sides of accounts added up equal to the credit sides of the accounts. However, we may find some of the accounts does not reflect the economic fundamentals of the company. I'll give you some examples in the next few minutes. And then after we do the adjustment, we will prepare financial statements and then we'll close the income statement account, which would be discussed in the next video. Well, during the period, accountants recorded revenues, expenses, assets, and liabilities, of course, stockholders' equity, which is rarely adjusted. So we are going to focusing on these four categories. Two issues when we recording those accounts, recognition, right? When or whether we should be recognizing a revenue account, for example. And how much in dollar amounts should we record it in that transaction that affects our revenue. However, even when we faithfully conducting our practices by abiding to the recognition and measurement rules that's set by the GAAP, some of the numbers that we reported at the end of the day before we adjust may not be accurately reflecting the economic fundamentals. So why does that matter? That matters because high quality information would help the investors and outsiders like banks, governments, and other agencies to make decision relevant information, which is the purpose of financial accounting. Now your question may be, why do we have to adjust? Why do we have some balances that not reflecting economic fundamentals? I'll give you some examples, but most of those examples are related to one issue, that is timing of the transaction. For example, a transaction this period may be an extension of a previous transaction, which means we recorded the effect of the transaction in the previous period, but that effect didn't show up in the first three steps in this first period of our accounting cycle. That is, if it's not showing up in the analyze, recording, and posting steps, you would have to adjust that. Let's go to see some examples so that you would understand what I'm talking about. So here is one example. This example, Chipotle has an unadjusted balance of $130 of unearned revenue at the end of the quarter, representing the gift cards purchased by customers in the past. During the current quarter, customers redeemed a portion of the gift cards for $52 in food services. All right, so this is the setup. Now, this transaction is complicated because it's intertemporal. It across two different periods. What does this transaction really mean is that cash is received in the past quarter as a deposit, which is in the form of gift cards, right? They purchase gift card, but we haven't provided any services, so it's not a revenue in the past period. But when they redeem the gift cards, it becomes a revenue. So cash is received in the previous period. So if I'm looking at the previous period, our company received cash, $130, unearned revenue, which means the liability to provide service in the future, is $130 on the credit side. So this is the effect of transactions from the last period. If I were to post this entry to my T accounts, I increase cash for 130, right? I also increase unearned revenue for 130. It's a liability account, so increases on the credit side. Now, this is why you will see at the beginning, so this is last period. So this is last period. You will see at the beginning of this period, so this period, you will see a beginning balance of 130 in the unearned revenue, right? That's what it means. You had an unadjusted balance of 130 in your T account. Now, what does this 130 mean? This 130 really means that we owe someone else a service of $130. All right. Now, if you look at these balances, if you look at this period's balances before you do the adjustment, you will see that, wait a minute, someone redeemed 52 already, which means we already exchanged some of the gift cards with food services, so we no longer owe someone else $130. How much do we owe someone else? Right? We owe them basically 130 subtracting 52. That's 78. We owe them $78, which means the correct balance of your unearned revenue should be $78 rather than 130. Now it connects the dots for you, right? At the beginning, I said some of the unadjusted balances are not correct. Why are they not correct? Because they do not reflect the economic fundamentals of the firm. For example, this $130 does not affect the real liability that the company has. So the real liability is $78, which should be $50 less than the 130. Now, the second question is that why didn't we catch the effect of the 52 at the beginning of the 3 steps? The reason is because the cash has recorded at the previous period. And during this period, there's no cash transactions. And when there is a gift card transactions, the accounting system didn't catch that effect. So when we review this $130, we know that it's not the right amount. We want to adjust the 130 to the right amount, which is the 78. So if you look at this, if you look at this adjustment, you should see that we need to adjust. As I said, we need to reduce our unearned revenue by 52. We also need to what? We need to recognize the 52 as revenue because we earn the revenue by providing the food services. So what happened is that we need to debit unearned revenue, which would, as I did in the previous slides, we would decrease the unearned revenue and bring the unearned revenue account to the right amount, and we will credit the revenue account. When we credit a revenue account, revenue increases, right? So we increase the revenue account for 52. It brings the revenue account to the right amount of $1411. So that's the idea of adjusting. Adjusting occurs because of timing of the transaction. Some transaction happens in the previous period, which has a prolonged effect casting to this period. The unearned revenue is an example of adjusting. Now let's take a look at the visualization of different types of adjustments. I advised the textbook figure by a little bit because the figure is a little confusing. So this is a timeline of a company. We have the periodical assumption that transactions happens in a certain period. So let's assume a quarter is a period. This first arrow, it's the ending period for the previous period. So this is basically the start of the current quarter. The second arrow represents the ending of the current quarter. So it's the beginning of the quarter. This is the end of the quarter. So transactions occurred during the quarter. At the end of the quarter, we are doing some adjusting entries. Adjusting entries can be classified largely in 2 different categories. One is called the deferral. The second is called accrual. Now, I want you to pay attention. Both deferral and accrual are related to the adjustment in the current period. Now, the textbook's figure looks like the accrual would be adjusted in the next period. That's not true. Accruals are and deferrals are all adjusting entries belonging from the perspective of the current period. So what is the deferral? Deferral are transactions that cash was received or paid in the past. So if you have some cash transactions in the past period, which will have a prolonged effect to the current period, it's called deferral. Now we talk about unearned revenue. If a customer put down some deposit in the previous period, causing a liability in the current period, if that customer redeemed the gift card, came to us for services, unearned revenue would be earned revenue. So the last period's revenue unearned will be deferred, recognized as revenue to the current period. We could also pay some dollars. We could also pay some cash in the previous period. For example, we could be subscribing to Wall Street Journal. We paid rentals at the beginning of the period, and the expenses when we use the rent, when we receive Wall Street Journal and start reading it, it becomes an expense. So those expenses will be recognized in the current period. So deferrals means the cash effect is in the past. The expenses and revenue effect are deferred to the current periods. That's why it's called deferral. Accruals, on the other hand, are cash effects that will be happened in the future. Okay, cash will be happened here, which is next period. This is next period. So we are talking about T and T+1, right? T is the current period, T+1 is the next period. So you are doing financial accounting in period T, you are trying to adjust. Okay, this is the bigger picture. So cash will be paid or received in the future, but in the current period, we need to recognize revenues or expenses. These will be called accruals. Now, what is an example of accrual? One example is interest revenue. For example, if we lend money to another company, we are going to receive interest, but we didn't receive it in the current period. That is why it is not recorded in our step 1, 2, 3. Rather, at the end of the period, we review our accounts. We realize that, okay, there is a portion of the interest revenues that we are going to receive in next period, but it belongs to the revenue this period because we earn the revenue when time passed by, right? When time passed by for period T, we earn the revenue. So revenue is earned in period T, but cash is going to be, the interest going to be received in the next period. In that case, we need to debit interest receivable, which is an asset that gives us future benefit, and then we are going to credit interest revenue. Pay attention, you are going to recognize revenue. Why? Because you earn the revenue during the period. Interests are earned by the elapse of time. Okay, it's a passive income. You don't have to do, basically you don't have to do anything. You just wait for the time to pass by. So this quarter passed by, and thus the interest will belong to the current quarter. We can't recognize revenue until we receive cash because the interest is earned during the current period when time passed by. All right. So to review each one of the transactions that the book describes, McGraw-Hill has a guided help video 4-1 that details every single transaction. But I discuss the reasons for adjustment in my video. And I want you to memorize these transactions and the entries because when you are in the CPA exam, when you are in your intermediate accounting, or even in our final exam, there are only so many types of adjusting entries that you're going to facing. So you just have to memorize it. Okay, if the company has unearned revenue, what would I do, right? If the company has interest, should be received in the future? What should I record? Those type of things. Use a piece of paper, write down each type of the transactions, and write down the generic entries. And in the exam, you could just take a look at the generic form and figure out the amounts that belongs to each category. That would be how you study the adjusting entries. All right, so this concludes adjusting, and please do watch the guided help video 4-1. I'll see you in the next video.